English for Financial Institutions. By Karol Siskind. Part 1, Money and Payment. Unit 1. The Euro. History. Before the idea of a common currency gained acceptance in Europe, considerable efforts were focused on dealing with currency fluctuations, a major economic headache that ensued after the collapse of the Bretton Woods system in 1971. The members of the European Economic Community, predecessor of the EU, decided to limit excessive exchange fluctuations by pegging the currencies to one another and the US dollar. The mechanism proved unsustainable and lasted only 15 months. The next attempt at monetary cooperation was the European Monetary System, EMS, launched in 1979 and built on the concept of stable but adjustable exchange rates, defined in relation to the European Currency Unit, EQ, a currency basket based on a weighted average of EMS currencies. The system functioned for 20 years and substantially reduced short-term volatility of exchange rates. This success was an encouraging backdrop for the creation of a single European market, with the free movement of goods, people, capital and services across borders. In the late 1980s, most of the member states came to the view that harmonized macroeconomic and monetary policy, as well as a common currency, were necessary to realize the full potential of the single market. The procedures and timetable for the introduction of the common currency were laid down in the 1992 Maastricht Treaty on European Union. The treaty contained provisions of the convergence criteria that countries would have to meet in order to become members of the Economic and Monetary Union, EMU. The criteria were designed to ensure that the single currency zone would be based on sound economic and monetary foundations. On the 31st of December, 1998, the conversion rates between the euro and the currencies of the participating member states were irrevocably fixed. On the 1st of January, 1999, the euro was introduced, replacing the EQ at par, that is, at a 1-to-1 ratio. The euro system, composed of the European Central Bank and the national central banks of the euro area member states, took over responsibility for monetary policy in the new euro area. This was the beginning of a 3-year transitional period during which the euro was used in cashless operations and for accounting purposes. For financial markets, this transition happened immediately, the ground was well prepared, and trading in financial markets was conducted exclusively in euros. On the 1st of January, 2002, the greatest cash changeover in history took place. It was a tremendous logistic challenge that involved the banking sector, retailers, security firms, and the general public. Thanks to thorough preparation, the changeover went very smoothly and was completed within 2 months. National banknotes and coins were withdrawn and ceased to be legal tender by the end of February 2002. Benefits. Dealing with multiple currencies entails costs and makes price comparisons difficult. The single currency removes these disadvantages and brings benefits to both consumers and businesses. Foreign exchange transaction costs were eliminated, which in itself was a huge accomplishment when one considers that these costs were estimated at 20 to 25 billion euros per year in the EU. Before the euro, volatile interest rates meant unpredictable costs. With the euro, inflation has come down to a low and stable level, which also means low and stable interest rates. Consumer borrowing is less expensive and future repayments less uncertain, while businesses have more incentives for investment. The euro brings price transparency to the single market. Consumers and businesses can easily compare prices for goods and services across the EU. This has the effect of increasing competition among suppliers and keeping downward pressure on prices in the euro area. The costs of financial intermediation, such as bank charges, are lower. In the euro area as a whole, there are more banks and investment funds, and thus there is more competition between them. Lower costs encourage more capital flows. The euro in Europe and beyond. As of publication date, the euro is the official currency of 20 EU member states. Denmark negotiated an opt-out from the obligation to join. Sweden, despite being obliged by treaty, refuses to adopt the euro, and its citizens voted against the common currency in a referendum in 2003. Monaco, San Marino, and the Vatican City have adopted the euro as their national currency by virtue of agreements with the EU, and may issue their own euro coins within certain limits. However, as they are not EU member states, they are not part of the euro area. Kosovo and Montenegro in the Balkans also use the euro as a domestic currency without any agreements with the EU, following the tradition of the German mark, which had previously been the de facto currency in these areas. Outside Europe, the euro is legal tender in French overseas departments, such as Guadeloupe and Martinique. In addition, a number of currencies are pegged to the euro, as in the case of the Danish krone and the Bulgarian lev. The euro is an attractive reserve currency for other countries. The share of the euro in official foreign exchange reserves held by central banks around the world stood at around 21% in 2023. Appearance. Euro coins are minted in 8 denominations, ranging in value from 1 cent to 2 euros. All coins have a common side, the reverse, featuring the denomination and a map of the euro area in the background. The national side bears an image specifically chosen by the country that issued the coin. Euro coins from any member state may be freely used in any nation which has adopted the euro. Euro banknotes are issued in denominations ranging from 5 to 500 euros. The designs of both sides are uniform throughout the euro area and depict architectural styles from Europe's cultural history. All the structures represented on the banknotes are fictional syntheses of the relevant styles. Euro notes have advanced security features built into them, such as a hologram, watermark, security thread, and a see-through number. Unit 2, Payment Systems. Structure. A payment system consists of the rules, procedures, instruments and technology that enable the transfer of funds between users of the system. Payment systems play a fundamental role in the economy by facilitating the exchange of goods and services. An essential component within such systems are payment service providers, PSPs, such as commercial banks or non-bank companies, who provide access to the system for the final users, the payer and payee. To transfer funds between PSPs, a payment system requires an intermediary that operates an electronic network where payments are processed. One type of intermediary is a clearinghouse, usually established by a banking sector association in a given country. In the process of clearing that it performs, batches of payment orders are routed several times a day to the receiving PSPs with details of payments for their customers. The clearinghouse also calculates and transmits the net positions between PSPs to the settlement agent. This role is performed by the central bank, thanks to settlement accounts that each PSP holds there. The central bank makes adjustments in the settlement accounts, reducing or increasing the amount in a PSP's account depending on the net change. In the second model, the central bank acts as an intermediary by operating a real-time gross settlement (RTGS) system. Its distinctive feature is that each payment order is settled individually upon its entry into the system in its entire, gross, amount, usually in a matter of seconds. RTGS systems used to handle a small number of high-value payments, but some central banks also make these systems available for retail payments. Until recently, retail payment services normally took up to a few working days to remit funds to the end user. The introduction of instant payments in many countries, with the use of RTGS or other dedicated systems, now offers the possibility of making funds immediately available to the payee. Payment instruments. In order to carry out payment, the parties of a transaction must agree on a payment instrument. Cash has the advantage of instant finalization of payment, however, its use has been steadily declining with the growing popularity of non-cash, cashless instruments. The most frequently used are credit transfers, direct debits, cards and checks. Credit transfers, also called bank transfers or wire transfers, are instructions from the payer to debit his or her bank account and to credit the payee's account. One type of credit transfer is a standing order, which instructs the bank to pay a fixed amount at regular intervals to another bank account. Direct debits are pre-authorized debits on the payer's bank account that are initiated by the payee. They are typically used to make recurring payments for utility bills, and unlike standing orders, which require the amounts to be fixed, direct debits can be used for varying amounts. A check is a signed written order from one party, the drawer, to another, the drawee, normally a bank, requiring the drawee to pay the indicated sum on demand to the drawer or to a third party specified by the drawer. The number of check payments has been declining to a point where they have almost disappeared in many countries, but continue to be widely used in the US and France. Mobile payments. Mobile payments are an increasingly important segment of payments across the world. One popular tool for conducting such payments are payment apps for mobile devices. After registering one's credit or debit card, or bank account details, users can purchase goods, pay bills, transfer money, via peer-to-peer payments, or withdraw money from cash machines. Mobile payment apps may function on a standalone basis, or as an integral part of a mobile wallet, that is a virtual wallet, which may also be used for storing electronic documents, such as tickets, boarding passes, ID cards, loyalty cards. Mobile wallet apps are often pre-installed on smartphones. Mobile devices can also be used for browser-based payments, where users visit an e-commerce website and make the payment using their card details. Cross-currency payments. When carrying out a transaction that involves paying in a different currency than that in which the payer holds his or her account, it is necessary for the payer's bank to have a presence in the country of that currency. To facilitate such transactions, a system of correspondent banking was developed. Correspondent banks are authorized to act as an agent on behalf of a domestic bank, opening accounts in the local currency called nostro accounts. This allows banks to conduct business abroad and provide services to their clients without the expense of a physical presence. Cross-currency payments also require a global financial messaging network that can exchange payment instructions between banks in different countries. The leading system of this type is SWIFT, Society for Worldwide Interbank Financial Communication, operating since 1977 as a bank-owned cooperative. SWIFT makes use of standardized bank addresses, known as BIC codes, Bank Identifier Code, which enable automated processing of payments. Remittances. A remittance is a low-value transfer of money from individuals, mainly migrant workers, to their families who remain at home. As cross-currency payment services offered by banks are relatively expensive, and require the payee to have a bank account, a number of non-bank entities have become specialized in providing such services. Western Union, the most prominent remittance service provider, operates a global network of access points for paying and receiving funds. Technological innovation has led to the development of new channels for remittances, for example using SMS messages which allow beneficiaries to withdraw the transferred amount at a cash machine. Card schemes have also entered the market with card-to-card transfer services. The remittance business has grown into a major industry, and for some countries, the inflow of remittances accounts for as much as 1/3 of their GDP. Unit 3, Payment Cards. Types of payment cards. A debit card is a payment card that is linked to a deposit account and allows the holder to withdraw funds from that account directly, at a cash machine, as well as indirectly, when a purchase is made. It is commonly issued by banks as part of a basic account package. In principle, use of a debit card is limited to the amount deposited in the account. However, some banks offer an optional or standard overdraft facility, subject to appropriate fees and interest. A credit card provides revolving credit, up to a specified limit according to the individual's credit rating. Credit cards offer the ability to either pay the purchase amount in full without incurring interest within a period of time called the grace period, or to make regular monthly payments. If a monthly balance is not paid in full before the grace period is over, the card issuer can charge interest fees on the entire outstanding balance. Monthly payments can be greater but not less than the minimum payment based on the annual percentage rate, APR. Wealthy customers are offered so-called premium cards, gold, platinum, black, etc., with benefits such as VIP access, concierge service and discounts on luxury products. A charge card is a card that charges no interest but requires the holder to pay his or her balance in full upon receipt of the statement, usually on a monthly basis. The balance cannot be rolled over from one billing to the next and a penalty is charged if it is not paid in full. While similar to a credit card, the major benefit offered by a charge card is that it has much higher, often unrestricted spending limits. For this reason, charge cards typically have higher requirements regarding credit rating and income. Prepaid cards, also called stored value cards, allow a set amount of money to be loaded onto a disposable card prior to use, or reloaded, recharged, multiple times. During a transaction, the purchase amount is withdrawn from the card's value. Closed-system cards are only accepted by a single merchant, often performing the role of a gift certificate, or for example used in public transport systems, like the Oyster card in London. Open-system prepaid cards are branded by a payment card company, which makes it possible for such cards to be processed similarly to traditional debit and credit cards. As a result, they are accepted at any merchant that accepts the brand on the card. An electronic purse or wallet is a type of multi-purpose prepaid card intended to facilitate small-value retail transactions. It is used in a number of countries as a substitute for cash at retail outlets, vending machines, car parks, ticket machines, etc. Another kind of prepaid card is the virtual card, which is specifically designed for use on the Internet. Instead of a physical plastic card, the issuer generally provides details of a card account, number, expiry date, etc., for online payments. Card technologies. The traditional technology, in use since the 1970s, is a magnetic stripe at the back of a card, capable of storing data and read by physical contact when it is swiped through a point-of-sale terminal or inserted into a cash machine. Depending on the terminal, a sales slip is printed for signature or the card's personal identification number, PIN, is entered on the PIN pad. A more sophisticated technology is the smart card, chip card, which has an embedded electronic chip that can store and process data. The cardholder's identity can easily be verified and information concerning withdrawals, sales, and bills can be processed immediately and transmitted to a central computer. Smart cards greatly improve the security of transactions and reduce the potential for fraud. A contactless smart card, also known as a proximity card, is a card in which the chip communicates with the card reader through radio frequencies. Also used for purposes of identification and physical access control, these cards can be applied in public transport systems and as electronic purses. Major payment card companies, such as Visa and MasterCard, have introduced cards that make use of the technology. Payment card networks. The success of payment card companies depends upon the creation of an extensive relationship with banks issuing the cards and merchants accepting them, which in turn guarantees availability of their services to customers. The most common type of payment card network currently in use is known as the four-party system. The four parties in the system are the consumer, the bank that issues the payment card to the consumer, the card issuer, the retail merchant, and the merchant's bank, the acquirer. The payment card company coordinates monetary transfers and the transmission of information between the issuing and acquiring sides. Examples include Visa, MasterCard, and all of the PIN debit networks. Another type of network is the three-party system in which the credit card company itself both issues cards to consumers and provides card services to merchants. As a result, only three parties are involved in a card transaction: the consumer, the merchant, and the card company. Most payment cards in three-party networks are non-bank charge cards, issued by companies such as American Express, instead of a bank. Various fees are involved in every payment card transaction. In a four-party system, an interchange fee is paid by the merchant's bank to the card issuer. The fee may take the form of a flat fee per transaction, a percentage of the purchase price, or a combination of the two. The interchange fee is generally passed on to merchants by their banks in the form of a merchant discount rate, that is a percentage of the merchant's sales volume. In a three-party system, the merchant pays the discount directly to the network. As merchant discounts may be as high as 5%, some large retailers have developed a strategy to bypass the payment card network by issuing private cards, which can only be used at the retailer's outlets. The retailers offer the incentive of lower card costs to attract customers. Unit 4, Cryptocurrencies. What are cryptocurrencies? A cryptocurrency is a digital representation of value that relies on cryptography to ensure its functionality and security. Cryptocurrencies provide a means to make payments and transfer funds by using a decentralized peer-to-peer network that bypasses traditional bank intermediation. Since the creation of Bitcoin in 2009, the field of cryptocurrencies has expanded greatly, with several thousand in existence today. Despite the reference to currency in their name, cryptocurrencies do not fulfill all the defining economic functions of money. Very few mainstream retailers accept cryptocurrencies, which limits their use as a medium of exchange. Cryptocurrencies are particularly vulnerable to volatility and fluctuation, which restricts their use as a store of value. And in turn, their unstable value makes it difficult to consider them as a reliable unit of account. Cryptocurrencies do resemble fiat currencies in the sense that neither have any intrinsic value. However, the value of existing fiat currencies is backed by the creditworthiness of the central bank that issues them. The value of cryptocurrencies is solely based on what people are willing to pay for them in the market. Blockchain and mining. Bitcoin and similar cryptocurrencies use blockchain technology to verify, update, and store the record of transactions. A blockchain is a database that is shared across a network of computers. The smallest unit in that database is a block, which is a set of transactions conducted between the users of the cryptocurrency. A chain is then created from these blocks that contains the history of past transactions. Thus, a blockchain is like a ledger of all past transactions, with a new block acting as a new page where current transactions are recorded. The whole process is possible thanks to members of the network, who validate transactions and arrange them into blocks. This activity is known as mining. In order to add a new block to the chain, it is necessary to solve a computational problem, essentially guessing a very long random number. The first miner to find the solution announces it to others on the network, who verify the solution and the correctness of the transaction. The incentive for miners to be first is a financial reward in the form of transaction fees and newly created bitcoins, or other cryptocurrency. In the early days of cryptocurrencies, mining could be performed competitively on standard desktop computers. But in recent years, the race for new bitcoins has led to the development of a whole new industry, so-called mining farms. Such a farm is typically a warehouse where thousands of specialized processing units are linked together to increase the chances of success. The power consumption of such farms is so big that access to cheap electricity is a prerequisite for profitability. To compete with mining farms, individual miners can form pools to combine their computing power and split the mined cryptocurrencies between the pool members. Bitcoin and altcoins. Bitcoin was launched by an anonymous developer and supported by a group of computer enthusiasts, keen on promoting a more transparent and equitable payment system. Its early popularity coincided with the global financial crisis, when a feeling of mistrust towards financial institutions was shared by many around the world. In 2011, Bitcoin attracted attention when it emerged that a notorious black market site selling drugs relied on the cryptocurrency's anonymity to function. Bitcoin's popularity rapidly accelerated when it became regarded as a profitable investment asset. Its price increased by 1,000% during the year 2017, which seemed a strong indication that a speculative bubble was growing. Bitcoin's value tumbled in early 2018, recovered in 2020 and proceeded to break new price records the following year. Another downturn in 2022 was sparked by rising interest rates, economic uncertainty and a string of high-profile bankruptcies. The volatility of cryptocurrencies continues to be very high. Bitcoin's success has inspired competitors to create alternative cryptocurrencies, also known as altcoins. Many of them attempt to address some of Bitcoin's relative weaknesses. Thus, for example, altcoins may offer faster transactions, lower fees, larger amount of coins in circulation, or different mining methods. Several altcoins, such as Ethereum, Ripple, and Binance Coin, have gained a considerable number of users and market share. Yet Bitcoin remains by far the most dominant cryptocurrency. It accounts for around 40% of total market capitalization. For normal users, as opposed to miners, the most popular way to obtain cryptocurrencies is purchasing them through online exchange platforms. However, cryptocurrencies cannot be deposited in a bank. They are held by their owners in a cryptocurrency wallet, a software application or hardware device that allow users to monitor their balance, send money and conduct other operations. Such a wallet stores the encryption keys used to digitally sign transactions, as well as the address of a particular asset on a blockchain. Stablecoins. A stablecoin is a new type of cryptocurrency that attempts to overcome the main weakness of traditional cryptocurrencies, that is significant price volatility. This is achieved by linking its value to a specified asset, for example the US dollar, cryptocurrencies, precious metals, or a basket of assets. This makes stablecoins potentially suitable for serving as a means of payment and store of value. There are a few hundred stablecoins currently in existence, although they have not yet achieved a significant share of the cryptocurrency market. The most popular among them is Tether, which is collateralized primarily by US dollar reserves. It was launched in 2014 and has managed to maintain its position despite accusations of market manipulation, insufficient financial reserves, and lack of transparency. Interest in this category of cryptocurrencies was amplified when social media giant Facebook announced in 2019 that it planned to create a stablecoin called Libra, later renamed Diem. Facebook's asserted aim was to provide a payment system accessible to anyone with a mobile phone. Governments around the world criticized Facebook's project. Its potentially global reach meant that DM could have threatened national currencies. In addition, a wide range of concerns, security, consumer protection, potential money laundering, lack of regulation, remained unresolved, which is why the project failed. The association behind DM sold its assets in early 2022. However, the threat of Libra DM, along with the gradual decline in cash payments, have prompted some central banks to explore the idea of creating their own digital currencies. As of 2023, several central banks, Nigeria, Jamaica, the Bahamas, have launched digital currencies. Other countries, for example China and India, have started pilot projects, with many more expected to follow. Part 2. Banking. Unit 5. Commercial banks. Core banking functions. A commercial bank is a financial institution which uses funds deposited by customers to grant loans. In other words, commercial banks act as intermediaries between those with surplus liquidity, deposit holders, and those in need of liquidity, borrowers. Banks gain revenue thanks to net interest margins, that is the difference between loan interest and the interest cost on deposits. The main types of deposits are current accounts, called checking accounts in the US, savings accounts and time deposits. Current accounts provide convenient access to funds on demand and payment instruments through a variety of channels, ATMs, online, etc., but offer no or very low interest to account holders. Savings accounts allow holders to maintain liquid assets while earning interest on their funds. Time deposits also pay interest, but place restrictions on when a depositor can withdraw funds. One type of time deposit are certificates of deposit, which are debt instruments issued by banks, normally with a high face value, a fixed term and interest rate, which can be held until maturity or traded in the secondary market. Loans can be classified into secured and unsecured loans. A secured loan is an agreement under which a borrower pledges an asset or property as collateral which can be seized in case of default, for example a house in the case of a mortgage loan. Unsecured loans, such as personal loans, credit card loans or overdraft, are extended on the basis of a borrower's creditworthiness, or a pledge made by a guarantor who will be held liable in case of default. It is also useful to distinguish between retail lending, such as mortgages, consumer credit, and various forms of corporate loans. These include revolving credit, used to provide liquidity for a company's day-to-day operations, term loans for the purchase of fixed assets, bridge loans, which provide interim financing until a long-term arrangement is obtained, project finance, the long-term financing of infrastructure or industrial projects, in which the repayment is derived primarily from the project's cash flow on completion. Diversification of banking activities. Until the 1990s, many banking markets were highly regulated and commercial banks were restricted from engaging in areas such as securities and insurance. These restrictions were lifted in the US and Europe, which opened the way for banks to extend the scope of their activities. One of the strategies that appeared was the concept of bancassurance, that is the cross-selling of insurance products through a bank's distribution channels, either within a financial conglomerate or in a joint venture with an insurance company. The deregulation of the banking sector has resulted in a significant growth of off-balance sheet, OBS, business. This involves financial instruments or services which generate fee income, and do not appear as assets or liabilities on a bank's balance sheet. Some of these instruments have been offered by banks for many years, for example credit cards, but the range of OBS business has been steadily increasing and now covers several areas. Firstly, there are various types of loan commitments in which the bank agrees to accept a credit exposure at a future date. Examples include credit lines, revolving credit, and trade finance. A second area of OBS activity involves funds management operations, in which the bank administers, holds and manages funds or property for the benefit of its customers. This may take such forms as asset management and the sale of units in investment funds. Two other areas of OBS activity are closely related to the process of financial innovation, that has introduced new and often complex financial instruments to the market. One of these areas relates to derivatives, which are instruments derived from an underlying asset, index or value and include futures, options, forwards and swaps. Derivatives are an important risk management tool for banks, which may also arrange or advise on derivatives transactions for their corporate clients for the same purpose. In addition, derivatives are used by banks for speculating on the derivatives market. The second type of OBS activity is securitization, which is the process where individual bank loans, future cash flows and other assets are pooled into tradable securities. Typically, a portfolio of loans is sold to a separate entity, called a special purpose vehicle, or SPV, which arranges with an investment bank to resell them to investors as bonds. Commercial banks typically securitize assets such as commercial and residential mortgages, auto loans, and credit card receivables. The securitization of their loan portfolios allows banks to raise liquidity by freeing up funds tied to existing loans, thus providing access to an additional funding source for new loans. Types of banking institutions. In many countries of the world, the commercial banking sector is relatively concentrated. That is, a small number of large banks hold a majority of the total banking assets. These large banks frequently belong to a wider structure, such as financial groups or holding companies. There are, however, other types of institutions that fall under the commercial bank category, which despite their smaller size often play a significant role in the banking markets of various countries. Savings banks are institutions that focus on retail banking, providing payment services, deposit and savings products, loans and insurance for individuals and small businesses. They have a decentralized distribution network that extends to local or rural communities. Although they are for-profit organizations, savings banks often contribute to local and regional economic and social development, for example by supporting infrastructure projects in partnership with local authorities. Building societies, also known as savings and loan associations or thrifts, specialize in providing residential mortgages by acquiring funds mainly through savings deposits. They are often mutually owned, that is, the depositors and borrowers are members of the society with voting rights. In recent years, building societies have expanded their range of services beyond mortgages so that the distinction between them and other commercial banks has somewhat blurred. A cooperative bank is a financial entity which belongs to its members, who are at the same time the owners and the customers of the bank. Cooperative banks are often created by persons belonging to the same local or professional community or sharing a common interest. Their aim is not to maximize profit but to provide the best possible products and services to its members. There is a similar type of cooperative organization known as a credit union, which is a non-profit institution that uses excess earnings to serve its members and communities. Unit 6. Investment Banking. Overview. Investment banking is an activity in which financial institutions engage in public and private market transactions for corporations, governments and investors. These transactions include the underwriting of securities, merger and acquisition advice, trading, and investment management. Standalone investment banks, which used to specialize in a full range of the above services, have nearly disappeared from the market because of the global financial crisis. Their role is currently performed by large commercial banks, often subsidiaries of financial holding companies, or so-called boutique investment banking firms which specialize in particular segments of the market. Securities underwriting. Investment banking institutions help raise capital for their clients, issuers, by purchasing the whole block of new securities issued by them and selling it to investors. In the case of equity underwriting, securities are usually offered in either initial public offerings, IPOs, from companies first going public, or additional issues from companies that are already publicly traded. Since the amount of money needed to acquire the issue may be too large for one underwriter, the firm acting as lead underwriter invites other firms to participate in a syndicate which jointly distributes the offering. The lead underwriter typically makes a commitment to the issuer to purchase all shares being offered. If part of the new issue goes unsold, any losses are distributed among the members of the syndicate. Underwriters make their income from the spread between the price they buy the stock from the issuing corporation, and the price at which the shares are offered to the public offering price, POP. The model for underwriting corporate debt securities is similar. The investment banking institution purchases bonds or other debt instruments from an issuer and distributes them among investors. The process is somewhat different with government securities, which are usually sold at auctions by a country's treasury or central bank. Most government securities are bought by primary dealers, that is, financial institutions that have a formal business relationship with the issuing institution. The primary dealers enter into competitive bidding, purchase the majority of securities on offer and then redistribute them to their clients. Institutions involved in investment banking may also act as underwriters in a method of selling securities known as private placement. The name refers to the fact that the securities are not listed or traded, and typically remain with the buyer. Companies issue debt or equity, and the underwriter sells the issue directly to institutional investors, such as insurance companies or pension funds. Mergers and acquisitions, M&A. A merger happens when two firms, often of similar size, agree to establish a single new company, while acquisition occurs when one company takes over another and becomes its new owner. Acquisitions, which are much more common, may be friendly or hostile. In the former case, the companies cooperate in negotiations. In the latter case, the takeover target is unwilling to be bought or is not aware of the intended takeover. The integration resulting from a merger or acquisition may be horizontal, when the two companies are direct competitors of one another, vertical, when it occurs either between a company and a customer or between a company and a supplier, or it may lead to conglomeration, when the companies represent different business sectors. In general, banks or investment banking firms play an advisory role in the M&A market. They use their research, analytical and legal resources to identify a potential target company, and carry out a deal that would enhance stockholder value for their client. The advisory role may be performed on behalf of a buyer, buy-side advisor, or a seller, sell-side advisor, searching for a suitable partner. Both parties enter into negotiations to determine the structure, price, mode of payment and other terms of the deal. Fees in M&A generally take the form of a percentage of the value of transactions. Trading. Trading securities and other financial instruments is a major source of income in the investment banking business. The bank or investment banking firm may act as an agent, broker, offering trading ideas and executing the client's orders, and receiving a commission for its services. It may also engage in proprietary trading, that is, buying and selling on its own account, not for the benefit of a client, often for speculative purposes. The traders act as market makers, which means that they hold an inventory in the asset they trade and are prepared to buy or sell at publicly quoted prices. They make money for the bank thanks to the difference between the bid and offer prices for a given asset, the so-called bid-offer spread. The counterparties to the trades include other banks and institutional investors. One of the main trading strategies employed by investment banking institutions is arbitrage. In the most basic sense, arbitrage is defined as buying an asset in a market where it is undervalued and selling it where it is overvalued. If such price differences occur, they are usually momentary, thus the transactions must be completed simultaneously, before one of the prices change. This is only possible in electronic financial markets. Another trading strategy relying on speed of execution is called high-frequency trading. It is fully automated and based on complex algorithms designed to analyze multiple markets and execute as many trades per second as possible. Small profits generated on each trade add up to high aggregate earnings. Investment banks and the financial crisis. Prior to the financial crisis, which started in 2007, investment banking in the United States was dominated by the Big Five group of standalone investment banks: Lehman Brothers, Bear Stearns, Morgan Stanley, Merrill Lynch, and Goldman Sachs. They all contributed to the subprime mortgage crisis by underwriting high-risk debt instruments and selling them to investors all over the world. When the housing bubble burst in the US, asset prices fell sharply, especially prices of mortgage-related instruments, and the investment banks suffered huge losses. Faced with the possibility of collapse, Bear Stearns was sold to J.P. Morgan Chase, a commercial bank. Lehman Brothers amassed more than $600 billion in debt and declared bankruptcy in September 2008. Merrill Lynch was bought by Bank of America in order to save itself from a similar fate. Morgan Stanley and Goldman managed to remain independent and solvent, but only because federal subsidies were made available to them. Both banks sought and received permission from the Federal Reserve to be classified as traditional bank holding companies, which would allow them to benefit from more stable earning streams. Unit 7. Central banking. Monetary policy. In most countries, the primary objective of the central bank is to maintain price stability, defined as keeping the inflation rate below a certain target, as it contributes to creating a favorable economic environment. Monetary policy, which is the management of a country's money supply and the cost of borrowing money, is carried out by central banks in order to fulfill that objective. The basic tool of monetary policy are open market operations. These are transactions on the open financial market, involving fiscal instruments such as government debt, with the purpose of regulating the total amount of money in circulation. When the central bank buys government debt from commercial banks, their supply of funds available for lending increases, which in turn causes market interest rates to fall. When the central bank buys securities from commercial banks, an opposite effect takes place. Open market operations are closely connected with another policy tool, namely short-term interest rates. The central bank typically determines several rates, the most important of which is known as the key policy rate or main refinancing rate, federal funds rate in the US. It is a target rate for short-term lending conducted between banks, usually enforced by the central bank through open market operations. Commercial banks can also borrow money directly from the central bank at the so-called discount window, for which a discount rate, also called the marginal lending rate, is charged. This allows banks to obtain funds to satisfy their temporary liquidity needs. A third rate set by central banks is called the deposit rate, which is the rate the central bank pays commercial banks on overnight deposits. This facility enables banks to manage their surplus liquidity. In many countries, banks are required to hold, on an account with the central bank, a certain fraction of customer deposits as non-loanable funds. This requirement, known as the reserve ratio, can be used as a tool by central banks to influence the money supply. Changing the ratio affects the amount of funds banks can lend. However, as a policy tool, such actions are taken infrequently. The monetary system in certain smaller countries, for example Denmark, Bulgaria, is based on an arrangement known as a currency board. It is a fixed exchange rate system in which the domestic currency is pegged to an anchor currency, usually the US dollar or euro. The system largely precludes the conduct of an independent monetary policy, as the central bank cannot influence money supply through open market operations or setting interest rates. A currency board may foster monetary stability due to the fact that interest rates and inflation are very closely aligned to those in the country against whose currency the peg is fixed. Financial stability. Central banks are assigned a key role in the safeguarding of financial stability. Uncertainty about the health of the banking system in general can lead to runs on banks. Disruptions in the functioning of financial systems, as evident during the subprime mortgage crisis and its aftermath, may have very serious consequences for the real economy. Therefore, central banks continuously monitor and analyze potential risks and vulnerabilities that may threaten the stability of the financial system. The results of their analyses are published, on an annual or semi-annual basis, in financial stability reports which present an array of indicators related to the risks and exposures of the banking sector and non-bank financial institutions. When a crisis does occur, central banks may perform a role known as lender of last resort. This refers to the temporary provision of liquidity at a penalty interest rate to an individual bank which is solvent, but faces substantial liquidity problems. It is offered only in exceptional circumstances and to prevent a situation where the failure of one bank could lead to the failure of others, known as the contagion effect, which could have a serious impact on the broader financial system and the economy. Central banks may also support a failing bank by facilitating its acquisition by another bank. Such a solution is usually preferred to a government bailout as it carries less risk of moral hazard, which occurs when banks believe they will not have to bear the full burden of potential losses. Reserve management and foreign exchange operations. Central banks are typically responsible for the management of monetary reserves. These are usually held in foreign currencies, and to a lesser extent, in gold. Foreign reserves enable the timely meeting of international payment obligations, for example debt servicing, maintain a country's creditworthiness, and serve as a contingency buffer for the domestic currency should intervention in the foreign exchange market become necessary. In a pure floating exchange rate system, market demand and supply determine the equilibrium rate. However, when fluctuations in the exchange rate produce undesired effects, the central bank may intervene in the foreign exchange market by buying or selling currency. A central bank might, for instance, allow a currency to float freely, but only between undeclared official limits, a price ceiling, and floor, which is known as a managed float. When a central bank intervenes in the foreign exchange market, there is an indirect effect on the country's money supply, which in turn drives interest rates in the direction opposite to the one intended. Therefore, central banks often decide to conduct a sterilized intervention, which means that the sale or purchase of currency is offset by a transaction having an opposite effect on the money supply. For instance, a central bank might sell its domestic currency and government securities at the same time and in the same value. Other tasks. Central banks are an integral component of the payment systems of their countries. They typically operate real-time gross settlement systems and perform the role of settlement agent. In addition, central banks are entrusted with the oversight of payment systems, that is ensuring their secure and efficient functioning, as an operational or technical system failure may threaten the stability of the currency and financial markets. In nearly every country, the central bank has the exclusive right to issue banknotes and coins, and is also responsible for managing the circulation of currency, which includes distribution, exchanging damaged notes, withdrawing from circulation, and destroying notes which are too damaged for further circulation. Unit 8. Multilateral Development Banks. Purpose. Multilateral Development Banks, MDBs, are international institutions that provide financial assistance to developing countries in order to foster economic and social development. This is achieved by financing various types of projects in the public and private sector. Such projects often deal with improving the poor quality of infrastructure, which deprives people of basic utility services and has proven to be a bottleneck to development in many countries. Some MDBs have a specific goal to alleviate poverty and reduce social inequalities, and therefore their projects also focus on education, entrepreneurship as well as rural and urban development. A common way of supporting economic development is providing loans to small and medium enterprises, SMEs, which often have limited access to financing. MDBs may provide assistance on their own, but projects are often co-financed with governments, other multilateral institutions, commercial banks or private sector investors. Another goal advanced by MDBs is environmentally sound growth, that is growth achieved without the depletion of natural resources. Projects that promote renewable energy and reduce the emission of greenhouse gases are also carried out. Furthermore, MDBs often support closer regional cooperation or integration, as it creates economies of scale by reducing barriers to trade, capital and labor. Types of assistance. Multilateral development banks provide several types of assistance to developing countries. They may offer a grant, which is a transfer of funds for which no repayment is required. This usually applies to countries with a reduced capacity to repay loans as a result of debt distress. MDBs also lend money, which may take the form of concessional or non-concessional loans. Concessional loans are extended on much more generous terms than ordinary market loans. They carry very low interest rates, or no interest at all, and are repayable over very long periods of time, even up to 50 years, with a grace period. Non-concessional loans are generally provided to credit-worthy beneficiary countries, but they also benefit from borrowing costs that are lower when compared to commercial loans. The majority of loans granted by MDBs are project loans. They are often co-financed with governments, other multilateral institutions, commercial banks, and private sector investors. In addition, some MDBs provide loans to support the budgets of beneficiary countries on the condition that their governments implement specific policy measures, for example structural reforms, fiscal consolidation or improving the quality of public institutions. This type of lending is known as policy-based lending. Furthermore, some MDBs make equity investments, mainly through private equity funds that in turn invest in enterprises in developing countries. This form of investment supports companies in their expansion and provides them with capital and expertise, which creates jobs and stimulates economic growth. In addition, MDBs finance or provide technical assistance, which involves the transfer of know-how and expertise in various areas. They also provide emergency loans to help countries cope with the consequences of natural disasters. How funds are raised. In the case of grants and concessional loans, financial resources are largely provided from the contributions of donor countries. In practice, most multilateral development banks have established a designated fund, for example the Asian Development Fund, created by the Asian Development Bank, which channels the contributions and disperses assistance. Such funds are usually replenished with new resources from donor countries every few years. In order to raise money for non-concessional loans, MDBs issue bonds which are backed by capital subscriptions of their member governments. These subscriptions usually consist of two types of capital: paid-in capital, which is actually paid to the MDB and constitutes a smaller portion of the subscription, and callable capital, which makes up the bulk of a country's subscription. The name callable capital relates to the fact that the money is not actually paid to the MDB but rather committed by its member countries. This is done because an MDB uses money from loan repayments to finance the coupon and principal payments on the bonds it has issued. If a beneficiary country defaulted on a loan payment and the amount of the bank's paid-in capital was insufficient to repay bondholders, the MDB would make a capital call, requiring member countries to provide part or all of their committed amount. Thanks to the financial backing of their member countries, MDBs generally have a strong credit rating and thus are able to borrow money in world capital markets by issuing bonds at low rates. This allows MDBs to re-lend the money to beneficiary countries at much lower rates than would be possible if these countries wanted to raise funds themselves by issuing bonds. Governance. The shareholders of a multilateral development bank are its member countries. They include both developing countries and developed donor countries, which are not limited to the region where the bank operates. The member countries are represented in a board of governors, which is the bank's highest decision-making authority. Generally, the governors are ministers of finance or development of their respective member countries. Voting shares in the board of governors are allocated in proportion to the member country's capital contributions. The governance structure of MDBs typically features a board of executive directors, to whom the board of governors delegates the oversight of day-to-day operations, lending and budgetary matters. There is also a president, selected by the board of governors, who manages the work of the bank. Part 3. Other financial institutions. Unit 9. Investment funds and hedge funds. Investment funds. An investment fund, called mutual fund in the U.S., is a type of regulated collective investment undertaking that pools together money from investors and invests it on their behalf. Depending on the profile of the fund, it may invest money in various types of securities and other assets. The combined holdings of the fund are known as its portfolio, and the assets in a fund's portfolio are managed by a professional manager, who decides which securities to buy and sell, based on the fund's investment objective, detailed in the fund's prospectus. Investment funds raise money by selling shares or units of the fund to the public, either directly or through intermediaries such as brokers and banks. The current price of a share or unit is represented by the fund's net asset value, NAV, which is the total value of the fund's assets divided by the number of shares or units outstanding. For most investment funds, the NAV is calculated daily, and an increase or decrease in the market value of the fund's assets causes a rise or fall of the NAV, resulting in a gain or loss for investors when their shares or units are redeemed. In terms of structure, there are two types of investment funds. The majority of funds in the market today are open-end funds, which issue and redeem shares or units on demand, and the total assets of the fund grow and shrink as money flows in and out. There is no limit to the number of shares the fund can issue. In the case of closed-end funds, a fixed number of shares, or investment certificates in some countries, are offered for sale during an initial public offering. After the IPO, the shares typically trade on a stock exchange, where the share price may be greater or less than the NAV. Closed-end fund shares are generally not redeemable in the US and UK, which means that a closed-end fund is not required to buy its shares back from investors upon request. Investment funds are also classified according to the type of assets that they primarily purchase. The three most common are equity funds, bond funds, and money market funds, each representing a different risk or return profile. In addition, certain funds are labeled according to their objectives, and reflect the proportion of safe and risky assets that are purchased. Thus funds may have names such as cautious, balanced, or aggressive growth. When a number of funds are offered by the same fund company, they are known as a fund family, and shareholders typically have the privilege to transfer their holdings from one fund to another within the same family. There are also funds that target specific geographic regions, countries, groups of countries, such as emerging markets, or specific industry sectors, for example technology. Another distinction applied to funds is based on the style of investment management. Most investment funds are actively managed, that is, fund managers continually buy and sell securities attempting to outperform the overall market return. In contrast, passive management involves buying a portfolio of securities designed to track the performance of a market index, such as the S&P 500 or Nasdaq Composite Index. This style of management is applied by index funds, which aim to achieve the same return as a particular market index by investing in all, or a representative sample, of the companies included in an index. A similar approach is applied by exchange-traded funds, ETFs, which also represent a basket of stocks that replicate a market index, but unlike index funds, ETF shares are traded in securities exchanges. Investors purchasing investment fund shares or units pay fees, which are deducted from the value of their investment. One type of fee, known as a load, is a commission charged by brokers for their services. This may be a front-end load, paid when shares are purchased, or a back-end load, paid when shares are sold. There are also no-load funds, which allow for shares to be purchased directly. All investment funds charge a management fee that depends on the size of the fund, its focus, and level of active management. Hedge funds. A hedge fund is a collective investment undertaking that is open to a limited range of investors, and can flexibly use various active investment strategies to achieve positive absolute returns, that is, returns that are positive in both bull and bear markets. These strategies often involve the use of leverage, derivatives trading, as well as taking long and short positions in securities or other assets in a wide range of markets. Unlike most traditional investment fund managers, hedge fund managers usually have a significant amount of their own wealth invested in their fund, which means that their interests are aligned with the interests of investors. This alignment is further reinforced by a performance fee paid to managers, calculated as a percentage of the fund's profits, usually about 20%. In addition, investors also pay a management fee to cover the operating costs of the manager. Hedge funds are usually limited by the type of marketing they can make to potential clients. They normally reach potential investors through word of mouth, representatives, brokers, or investment advisors. Moreover, hedge funds establish minimum initial investment requirements, which may vary but on average range from $500,000 to $1 million. As a result, hedge fund investors include high net worth individuals and institutional investors, such as pension funds, corporations, and funds of hedge funds. As in the case of traditional investment funds, hedge funds sell shares which are valued according to their NAV. Despite usually having an open-end structure, hedge funds normally impose restrictions on the withdrawal of invested capital. This usually takes the form of a lock-up provision, which states that during an initial investment period, usually 1 to 2 years, investors are not allowed to redeem their shares. Another type of restriction is a gate, which limits the percentage of invested capital that can be withdrawn following the lock-up period. In addition, investors must provide notice that they intend to redeem shares. Compared to traditional investment funds, hedge funds are subject to relatively lenient regulatory oversight. Many hedge funds are domiciled offshore, where rules concerning taxes, licensing and disclosure are particularly lax. However, following the financial crisis, many jurisdictions, including the US and EU, adopted legislation bringing hedge fund management companies under increased regulatory requirements. Unit 10. Insurance companies. Insurance companies assume risk on behalf of customers who want to protect themselves against potential loss. The cost of this loss is transferred to the insurance company in exchange for monetary compensation called a premium. Insurance companies make a profit by charging premiums that exceed the expected claim to the company, and by investing premium income. Insurance companies are usually classified into two groups, life and non-life insurance companies. In most countries there is strict legal separation between these two types of entities. This results from the fact that the life insurance business is very long-term in nature, while non-life insurance covers shorter periods. Thus life and non-life products are modeled quite differently. Business model. The most common form of organization for insurers is the public limited company. These companies are often wholly owned subsidiaries of an insurance group or holding company, which is not an insurer itself. Such a structure dominates among insurance giants, such as AIG, AXA or MetLife. Another type of organizational form is the mutual insurance company, which is owned collectively by its policyholders. The company's earnings are distributed to policyholders in the form of dividends or reduced premiums. A less common form of organization, found mainly in the US, is a reciprocal insurance exchange. It is an association of individuals or entities, with each member of the association assuming the risk of the other. Finally, a unique type of organization is represented by Lloyd's, which is not a company, but rather a market where members join together as syndicates to insure risks. Much of Lloyd's business works by subscription, where more than one syndicate takes a share of the same risk. The distribution of insurance products takes place through a number of channels. Most insurance companies contract with insurance agents, who legally represent the company and sell insurance policies on its behalf. If an agent represents only one company, he or she is known as a captive or exclusive agent, while agents who have contracted with multiple companies are known as independent agents. Another type of insurance intermediary is the insurance broker, who is not affiliated with any insurance company. Brokers are independent and represent only the interest of their clients. They solicit quotes from a number of insurance companies in order to find the best policy at the best price for their clients. Furthermore, insurance companies may sell their products at branch offices or over the internet. Life insurance and annuities. Life insurance is a contract providing for the payment of a specified sum to a named beneficiary upon the death of the policyholder. The simplest form of life insurance is term life insurance, which provides coverage for a specific period, term. The benefit is paid if death occurs during the term. In the case of whole life insurance, the policyholder is covered for his or her entire life. Unlike term life, whole life insurance, also called permanent life, accrues cash value over time. If the policy is cancelled, the cash value is paid to the policyholder. Both the death benefit and cash value are guaranteed. A variation of whole life is universal life insurance, where the death benefit and cash value are two separate components, usually not guaranteed, whose value may be flexibly adjusted. Finally, with variable life insurance, there is a distinct component where cash may be invested in a variety of investment funds. An annuity is an investment vehicle offered by insurance companies, which provides a regular income for retirement. Annuities are usually purchased by individuals to supplement the income achieved through government-sponsored pension plans. Money that is accumulated during employment is deposited, either by means of regular premium payments or a lump sum payment, into an annuity account, and upon retirement, the annuitant starts receiving periodic payments that typically continue for the duration of his or her life. Non-life insurance. Non-life insurance, known as general insurance in the UK, and property and casualty insurance in the US, is a category that refers to insurance products with the exception of life insurance. It provides financial coverage against the random occurrence of specified events, such as damage to property, loss of income, health, or legal expenses. Non-life insurance includes a number of well-known lines of business, such as home insurance, motor vehicle insurance, health insurance, as well as a broad range of others. A feature common to most non-life insurance policies is a deductible, which is a fixed amount or percentage of an insurance claim that is the responsibility of the insured, and which the insurance company will deduct from the claim payment. In certain types of policies, deductibles are voluntary, but usually they are imposed by the insurer to avoid paying a large number of small claims. The higher the deductible, the lower the premium charged for the same coverage. Reinsurance. Reinsurance is a transaction in which one insurance company, or a group of companies, indemnifies another insurance company against the loss it may sustain under its policies, in return for a premium. The company purchasing reinsurance is known as the ceding insurer, while the company selling reinsurance is called the assuming insurer, or reinsurer. There are many entities that focus their business on reinsurance, such as Munich Re or Swiss Re, although it is also common for primary insurance companies to engage in reinsurance. Furthermore, in recent years, a new structure of reinsurance has developed, whereby risks of various kinds, particularly of natural disasters, are sold by insurers and reinsurers to institutional investors in the form of catastrophe bonds and other alternative risk-spreading mechanisms. These bonds include a provision stating that if the issuer, an insurance or reinsurance company, suffers a loss from a predefined catastrophe, then the issuer's obligation to pay interest and/or repay the principal is either deferred or completely forgiven. Unit 11. Pension funds. A pension fund is a financial institution, usually sponsored by a non-financial entity, which collects, pools and invests funds contributed by sponsors and beneficiaries for future payments to the latter in the form of pensions. Pension funds are typically sponsored by employers, companies, public estate institutions or trade associations. These sponsors administer pension plans for their employees or members. Pension funds allow individuals to accumulate savings during the course of their working life that are set aside to provide retirement income, either by means of a lump sum or an annuity. The three-pillar system. In many countries, the system for providing pensions consists of three distinct pillars. The first pillar comprises public or state pension schemes, such as Social Security in the US and National Insurance in the UK, which usually provide a safety net for the elderly in the form of a pension that guarantees basic subsistence. Such schemes offer universal or near-universal coverage, thus encompassing persons who did not make contributions due to unemployment or illness. First-pillar pensions are typically unfunded systems, that is, money that workers contribute today pays benefits to current pensioners. This method of financing is known as pay-as-you-go, PAYG. Apart from pensions for retirees, in many countries the first pillar also provides disability benefits and a benefit for a surviving spouse if the retiree dies. The second pillar consists of occupational pension schemes, which are provided as part of an employment contract. Such schemes are mandatory in some countries, such as France, Switzerland, but voluntary in others, US. Occupational pension schemes are typically established by employers or groups of employers, for example industry associations, and are funded, that is, contributions from the employee and/or employer are deposited on individual accounts of the members. The contributions are invested and the return on investments is accumulated on the individual accounts. The third pillar signifies specific retirement savings products that are purchased by individuals to top up their future pensions, provided by first and second pillar schemes. These are voluntary plans for individuals who are willing to pay additional contributions in order to maintain a higher standard of living during retirement. Second and third pillar plans are characterized by defined contributions, whereby the future benefits to members are based solely on the amount contributed to the plan by the member and/or sponsor, plus the return on investment. Legal forms. There are three broad types of legal forms operating as pension funds. In Anglo-Saxon countries, the dominant form is the pension trust, where named people, trustees, hold property on behalf of other people, beneficiaries. The trustees can be a board of people or a corporate trustee, which acts in the exclusive interest of the pension members and beneficiaries. Depending on the country, the trustee may have responsibility over all aspects of administration of a pension plan, or may simply hold title to the assets, while fiduciary managers, such as asset management companies, may be delegated responsibility over the management of the fund. In the corporate form, the pension fund is a separate corporate entity where the plan members have legal title to the pension assets. Depending on the country, this entity may be a mutual association, cooperative, investment society or public limited company, and it bears responsibility for administering and managing the fund. In a number of countries, this role is performed by foundations. The third form is of a contractual type, where the pension fund assets are held in an account managed by a financial company. The account is legally separated from the balance sheet of the managing entity, which is the governing body of the fund. Only certain types of financial institutions are authorized to offer such contracts, for example banks, insurance companies or specialized financial institutions. Pension funds are also classified as either closed, that is supporting a retirement plan restricted to specific participants, for example employees from a specific company, industry, or government agency, or open, that is supporting retirement plans that do not have membership restrictions. Regulatory restrictions and fees. The value of funded pensions can depend critically on the fund's investment performance. In order to protect people's savings, many countries impose various types of restrictions on pension funds. These include restrictions on industry structure, such as the separation of the pension fund management industry from other financial institutions. Another type of regulation is related to pension funds' performance. Rules in some countries specify an absolute return that funds must earn, related usually to the industry's average performance or to the returns on a benchmark portfolio. Some countries impose quantitative restrictions, maximum limits, or ceilings, on the share of particular types of assets held by pension funds, most commonly on risky assets such as shares and corporate bonds, and the amount that can be invested in foreign assets. A number of countries impose a minimum level of investment, floor, in public sector bonds. In Anglo-Saxon countries, the imposition of strict portfolio limits is avoided in favor of regulating the behavior of investment managers, by means of the prudent person principle. Under this principle, each investment is judged on its individual merits and risky investments are to be averted. Providers in second and third pillar pension schemes charge one or more types of fees. The most common is the fee on contributions paid by members, as a percentage of contribution or salary. Other types of fees include a fee as percentage of total assets under management, and a transfer fee for switching to another pension fund. Some countries have introduced maximum limits on the fees that pension funds can charge to ensure that administrative costs do not reduce the retirement income of participants. Unit 12. Credit rating agencies. The role of credit rating agencies. A credit rating agency, CRA, is a company that provides independent opinions concerning the credit risk of issuers of debt securities and individual debt issues, that is the risk that issuers of these securities may not make full and timely payments of amounts due. Although credit rating agencies are not financial institutions in the sense that they do not provide financial intermediation, CRAs play a very important role in global securities and banking markets. Their assessment of the creditworthiness of issuers may affect the interest rate applied to debt securities, thus determining how expensive it will be for corporations and governments to borrow money. In addition, for corporate and sovereign debt issuers, credit ratings give access to public bond markets, which extends their ability to obtain funding. Furthermore, some banks and financial institutions are required to use credit ratings as reference for the calculation of their regulatory capital requirements, which are risk-based, while certain institutional investors are barred from purchasing debt unless these securities have credit ratings above a specified threshold. For investors, credit ratings provide a means of comparison between a multitude of debt issues in terms of their underlying credit risk, thus facilitating optimal investment decisions. There are currently over 100 CRAs operating throughout the world, differing considerably in their size and focus. Most are small organizations, specializing in particular countries, regions, or sectors. By contrast, the three largest agencies, Standard & Poor's, Moody's, and Fitch, have a global focus, providing credit ratings both for corporate and sovereign issuers worldwide, as well as for a wide range of specific debt instruments. The rating process. The rating process usually begins with a request by an issuer or its underwriter, prior to a planned offering. The CRA will assign a lead analyst to prepare the rating. The analyst gathers information from the issuer and other available sources to gain a better understanding of a company's business fundamentals and competitive position. In addition, extensive meetings are held with senior management or government officials in order to review key operating and financial plans, as well as strategies or policies. The analyst then prepares a draft report and a recommendation concerning the creditworthiness of the issuer and/or its securities. This report is submitted to the CRA's rating committee, which then assigns the credit rating. CRAs commonly issue a press release with the rating, to communicate its decision to the market by explaining the key elements underlying the rating. Ratings are usually posted on the CRA's website, making them freely available to all market participants. Each agency applies its own methodology in measuring creditworthiness and uses a specific rating scale to convey its rating opinions. Typically, ratings are expressed as letter grades that range, for example, from AAA to D, to communicate the agency's opinion of relative level of credit risk. A credit rating agency will use the same scale for all types of debt instruments, corporate, sovereign, etc., to ensure comparability for investors. However, short-term debt is usually rated by means of smaller scales. Instruments rated BBB or above, BAA in the case of Moody's, are considered investment grade, while a rating of BB, BA, Moody's, or lower is assigned to speculative, high-yield instruments. The bottom end of the scale signifies payment default on financial commitments. Rating outlooks and reviews. Following the initial rating, the process of surveillance starts. Rating agencies continue to monitor the credit quality of the issuers whose rating they prepared, so that investors can be assured that the rating is based on current information and up to date. Furthermore, CRAs are expected to provide ample warning should developments with regard to a particular issuer have a possible impact on its rating. Therefore, in order to communicate their evaluation of developments and factors that might affect a previously issued rating, CRAs publish rating outlooks and reviews. Rating outlooks indicate the anticipated direction of a rating over the intermediate term, 6 months to 2 years. A positive outlook suggests that a rating may be raised, negative means it may be lowered, stable implies that a rating is not likely to change, and developing means that future events are so unclear that the rating may potentially be raised or lowered. Rating reviews represent a more direct indication of future changes compared to outlooks. They signify that there is a very high probability that a credit rating will change in the short term, usually within 90 days. Each agency has a different name for its rating review. Moody's places a rating on a watch list, Standard and Poor's on Credit Watch, and Fitch on Rating Alert. A rating may be put on review for possible upgrade, downgrade, or, more rarely, with direction uncertain. However, if an agency has all the information to warrant a ratings change, it may do so immediately, without placing it in review. Typically, an updated outlook or review includes the rationale for the potential change and the extent of the change, up or down, that may occur. However, updating a ratings outlook or review does not imply that a ratings change is inevitable. The 2008 financial crisis put into question the reliability of ratings issued by CRAs. Their substantial underestimation of the risk inherent in complex finance products, such as mortgage-backed securities, was one of the major factors that led to the financial meltdown. Business model and other services. Credit rating agencies are paid for their services by either issuers or investors. Under the issuer pays model, which is the dominant remuneration model currently used, CRAs charge issuers an upfront fee for providing a rating. The fee depends on the size of the issue and type of security. In addition, an annual surveillance fee is charged. Rating agencies that use the investor pays model, also known as the subscription model, charge investors and other market participants a fee for access to the agency's ratings. In addition to issuing credit ratings, some CRAs offer ancillary business services to financial institutions, which may include financial research, credit and operational risk management, providing access to financial data, consulting and advisory services. Some CRAs are affiliates of larger enterprises that operate various lines of business.